All right, so let's face it, there's a lot of hand-wringing going on about how things went down yesterday. But the stock market, it came out with a lot of gusto, right? And I've always said it's the day after the FOMC gathering that really matters. That's when you can assess how investors feel. It's clear that many people are sort of wondering if the Fed, if they're not done, they're almost done. If that's the case, maybe they should be looking to make some money. Netflix, by the way, leading the charge. Word is Apple going to invest over $1 billion on movies that will be released in theaters and other platforms. So again, you've got these mega cap names leading the parade. Let's bring in Entrepreneur Share COO Eva Ottos along with Keith Fitz-Gerald of the Keith Fitz-Gerald Group. And first, I want to get an idea. Today's action, does it mean that maybe the street is cool with just one more rate hike? And if that's the case, Eva, do we start to see a greater sense of urgency that the train is leaving the station?
Our view on the markets didn't really change before the Fed meeting and after. So the Fed signaled, yes, we're going to have probably one less rate hike than what we initially expected. So instead of 4, we're going to have 3. That means one more. On the other hand, the banking crisis is doing the work for them. We now have tightening bank standards. And so the bottom line is the net effect is the same. So our view on the markets is the same it was on Monday.
And what was that?
So we continue to expect that entrepreneurial companies and growth companies will outperform as inflation is going to continue to come down. But that being said, there is a lot of volatility in the market. And so for that reason, we're moving higher in market cap.
Okay.
We're looking at great margins, cash flow, and low debt.
All right. So, Keith, one thing, though, the air is coming out the balloon a little bit, right? I mean, are people buying the dip, selling the rip? What the heck is going on?
I think they're doing exactly what Eva is talking about. We're, in fact, in that exact same camp. Now's not the time to hit home runs. Now's the time to move up the value chain, go for the bigger, more liquid names, the things that can protect your capital and grow it at the same time, no matter what stinking stupid things the Fed does next.
All right, so with that in mind, now, Eva, first of all, I got to give you a shout out, right? Entrepreneur Share ETF up 20% the first 3 months. I mean, the Russell's been hot. The Russell 100 growth has been hot, and that's up almost 9%. So you're just smoking it right there. But you're saying maybe, you know, when you say move up the food chain, these are to more established, I wouldn't say they're entrepreneurial companies anymore, are they?
So, Charles, the key thing here, and many people don't know this, if you look at the Russell 1000 growth, 50% of the return comes from 2 names and 90% of the returns comes from 5 names. That's how concentrated they are. Now, compared to that, 50% from our returns comes from 12 names and 90% from our returns comes from 30 names. That's how diversified our performance is, and that means less concentration risk, not just compared to the Russell 1000 growth, but even more to well-known innovative funds who are in days that, like today, they're struggling with key names where they're very highly concentrated on. So I think diversifying your portfolio and being careful with concentration risk is key in these volatile markets.
You know, but the irony of that, of course, is Microsoft and Apple are 13% of the overall S&P 500. So there's a double-edged sword there, too. Keith, I was reading where you like big brands and big margin protection and dividends. And I've never put dividends and Keith Fitz-Gerald in the same sentence before.
Well, it's my alter ego speaking. You know, dividends are really great. Here's why, Charles, is because, you know, even if the stocks fall and you've got a company that's firing on all cylinders, that the customers want their products, that they're continuing to beat a path to their door, energy, for example, defense, for example, those are things that can grow even if the stock market themselves get weak. So that's why we're focusing right now on those big particular names.
Right. And I know you like Lockheed Martin and Chevron, for example. I got less than a minute to go. Eva, what do you like here?
So I like Salesforce and I like Google. And again, we're going up in market cap. Both companies have very good margins, very good. They're growing their EBITDA in a very high rate. And I like the fact that they provide some stability in this market. So we always own these companies, but we now have moved them to a higher weight in our portfolios.
Well, congratulations again. That's a sizzling start to otherwise tough year for most folks, so congratulations. I know it ain't easy. Keith, thank you so much, my friend.
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.